Hey everybody, this is Alex Hodes here. I'm here to discuss the recent EU sanctions that were placed on Nayara Energy's refinery in India, which is a major supplier of diesel supplies to the EU. In addition to that, there was a fresh wave of sanctions, blacklisted more Russian oil companies or banks associated with them. And so I'm here on July 18th to discuss basically the market impacts. So this Indian refiner has been supplying about 400 to 500,000 barrels per day of diesel to the EU. This accounts for almost a quarter of diesel imports from the EU. So the market is now just kind of scrambling to look for alternative buyers. The EU will primarily look to the Middle East as well as Asia and the US to kind of fill that void. We've seen markets rip substantially higher. Diesel prices prior to the sanctions were around 240. They're now up closer to $247 per gallon. On the gas oil side, which has really been the driver of this market, prices are at $725 per metric ton. Prior to these sanctions, they were closer to $700. So there's quite a bit of a rally that's occurred due to this. So likely Middle Eastern supplies and Chinese supplies, Asian supplies will come to fill the void that's left here. And there will obviously be some kind of flows that are going through alternative countries to disguise where this flow is coming from. So there is going to be a change in the flows of diesel, but really where the premium that lies in European gas oil is the fact that Indian refiners, they have been purchasing this discounted Russian crude oil. And so that's made their supplies substantially more competitive than some of the others. So now Europe has to basically have a higher premium to attract more barrels from the US, the Middle East, and other Asian suppliers. So we expect this to be almost a 8 cent per gallon premium from prior to the sanctions in heating oil. And then on top of that, we could see about an 8 cent premium from European gas oil to heating oil in order to attract more barrels from the U.S. Gulf Coast or the U.S. Atlantic Coast as well. This has really been exacerbated by the already tight supplies across diesel across the globe in the U.S. and in Europe. So this has kind of exacerbated that move higher and why we're seeing quite a bit of that volatility. There will be additional refining capacity that's set to come online in Q3 and Q4. So that capacity, though, is not coming online in Europe. It is coming online in China and Bahrain as well. So this would be about 500,000 barrels per day of capacity, but it will take time for these barrels to get online and kind of fill that gap. So we do expect a premium to exist. We're still expecting Q3 heating oil price targets around upper 240s or low 250s. And then on top of that, we're expecting European gas oils to be almost around that $800 per metric ton range. So quite a bit to go from where we have. We started the morning up substantially, and the market's kind of retraced itself. So the market's really trying to digest where we're at, but we do expect a bit of a premium, and that's also to do with just the amount of tight supplies that are in the diesel market so far. But overall, we expect this to impact Europe, and sometimes that gas oil, because there's so much more volume traded in European gas oil, that brings along heating oil with it. We expect this to kind of last through Q3, but hopefully those supplies, additional refining capacity will come to kind of fill the void, and these flows will redirect and kind of settle in. Thanks.